Market value addition and economic value addition are both measures to evaluate managers' performance. So each one of these variables give us some insight to how the manager has been doing. Right? So market value addition looks at the difference between the market value and the book value of the firm. So the difference between the two is the value addition that the manager has done. Right? So for the shareholders' wealth, how much is the shareholders' wealth worth in the books, and over time, how much is it worth in the market? The difference between the two would be considered the long-term wealth of the shareholder. So it's an easy measure. It's tracked by the market performance. So it's tracked by the stock price and how many stocks are outstanding. That will give you the market price, and the book value is the total equity that you have on your balance sheet. Right? So the balance sheet, this includes, and if you look at the book value, the balance sheet would include values about when the first time the stock was generated, how much was it worth, how much was collected for that stock from issuing those stocks, and later over the years, how much retained earnings have been collected and set aside by the firm. Both of these belong to the shareholders. So that's the book value of the wealth, and then it's compared to how much is it trading for in the market, right? So we'll get the value of the market value of the stock. So the difference between those two is the market value addition. Economic value addition, on the other hand, it's not tied to the market price of the stock, but it rather looks at the economic profit of the business. So if you look at the business as itself, then the revenue, so if you are investing in the business is a product. So for you, the revenue is how much profit that the firm is making, right? So now we're deciding which firm to invest in. In that case, the firm which has the highest revenue or making the highest amount of profit, right? So that's going to be our, in this case, we are going to consider that's the revenue of the business. Whereas the cost, right? So instead of, now that the product is the business, the cost is, once this profit is earned, how is this profit shared? So how much of this has to go to your debt holders? How much will this have to go to your equity holders? Right? So our profit, our revenue is the profit of the firm, and then our cost is how much we have to pay for this capital. So you can see when we are calculating economic value addition, it's the difference between the profit, the net operating profit after taxes, right? So this is not tied to any capital structure, minus your cost of capital, right? How much was invested times what is the cost of capital. So how much, on an average, how much do we have to pay out our investors, our debt holders and our investors? The difference, that's the economic value addition. So after paying investors, after paying debt holders, this is how much of the profit is left, right? So that's economic value addition. It tells you the true performance of the firm. So both are good measures. However, there are certain issues with market value addition. Since market value addition is tied to the stock price, you see over here, the market value addition is tied to the stock price. So this stock price moves. As you know, the stock prices are extremely volatile. One day it could be up, the next day it's down. So market value addition, if you are pricing it on a daily stock price, it could be highly volatile. It depends on when you're evaluating, when you're calculating the market value addition. The market valuation could be very high if it was a good day in the market, or it could be extremely low because it was a bad day in the market. Right? So it might reflect the performance of the manager, but it might also reflect market movements of what is happening in the overall stock market. So the sensitivity with the market price, it causes market value addition to be quite volatile. So maybe the market is doing really well. If the overall stock market is doing well and it's pushing up all stock prices, including the one that we're interested in or the manager we're evaluating, then the overall stock price goes up. Our stock's price also goes up. So it's not really related to how the manager did, but instead how the stock market performed. On the other hand, if it's like a very poor day in the market or it's a poor period in the market, everything is crashing, then despite all of the best efforts by the manager, the stock price could still be low. Right? So if we're using market value addition to evaluate the manager, we might wrongly evaluate that the manager is not doing well. Right? Despite a manager's good performance, because the stock price is low, we might come to the conclusion that the market value addition is low, so therefore the manager is not performing well. So that's one large shortcoming of the market value addition. One other thing for it being tied to the market price, that means that you need to have a stock price, right? So if this firm is not publicly traded, if this is a private company, that is not like, you cannot buy the shares for the stock, that means there is no stock, there's no stock price. If there is no stock price, then how do we even calculate market value addition? And so we cannot use this market value addition for privately for privately held companies. It's only for publicly traded firms. And for a firm, you only have one stock price, right? If we want to evaluate, that means you can only evaluate the top managers of the firm. But if you want to evaluate, say, a department manager, you want to evaluate how the sales department is doing, how managers in the marketing department are doing. We can't really do that. We can only evaluate the company as a whole because there is only one stock price for the company. If we want to compare performances of franchises or different branches, again, market value addition will not allow you to do that. Economic value addition, on the other hand, this is tied to the profit or how much was made by that department. So if you want to evaluate, say, just a particular branch, then we can find out what is the net operating profit after taxes of that branch and how much did we have to pay in terms of cost of capital for that firm, for that branch. So economic value addition, you can use this for departments, for divisions, for branches, which we cannot use for market value addition. And economic value addition, this is not tied to the stock price. It is based more on the fundamentals, so it gives a better reflection of the manager's performance than market value addition does. It's not going to be volatile. It's not going to be, economic value addition is not going to be changing from day to day. EBIT, you can get this for the month, and depending on the performance, it could be a steady performance unless there's a lot of fluctuations in the profit or the cost of capital, which there isn't. Then your economic value addition should not be volatile either. Right, so those are the two. If you're calculating market value addition, it's the stock price. So in this case, the stock price is $2.25 times how many shares outstanding, and minus the book value. So if you go back to number of shares for 2020 is 100,000. The stock price is $2.25. And in your balance sheet, you can see that total equity is 492,592 is the sum of common stock and retained earnings. Usually there are a lot more items, but for our simplified example, those are the two only items we have for calculating total equity. You can also see total equity from the stockholders, from the statement of stockholders' equity. So again, the very last line, balance as of the end of the year, 492,592. Okay. So you can use that to calculate the market value addition.